Okay, good morning.
Good morning. Good morning.
I
Did you
realized
end
it's
up?
the same, it's the same link. I just went to my old link and tried it. So it's the
Yeah. So you didn't
same.
receive the message. You didn't receive the message again.
No.
I see what's going on with. I think it's just yours specifically.
Yeah.
Okay.
6021. You gave him 6021?
Okay. All right. We're gonna go ahead and start.
Oh, he know it's just one trip. Yeah, he go.
You're on here. Good morning. Good morning. Good morning, everybody. Happy Monday. We are at the end of the pretty much the end of April. 4 months in, 8 more to go. About a third of the way of the year. Hope you guys all had a good weekend, a good past week. We're going to start off. I kind of mentioned it to the people that were here a little bit earlier. We're going to start off with some, real estate news, kind of going over some of the data, and then we'll jump into a couple things that's including the loan level price adjustments or the new Biden law or Biden rule, whatever the case is, and kind of go over that in depth. There's a lot of misconceptions that are out there about lower credit borrowers getting better premiums and stuff like that. So we'll be talking about it. We did already, go over this back in January. I know Shamika, maybe Nikita was there that meeting. Nikki and Kia are usually at all the meetings. So we kind of went over those loan level price adjustments back in January when they were first announced. But everybody's talking about them now because they are starting in April. So we'll be talking about that. But first, existing home sales. And those measure closings on existing homes, they fell 2.4% from February to March to a 4.4 million unit annualized pace. Sales were 22% lower than they were in March of last year. February was pretty strong for home sales, so the decline from month to month isn't too surprising. It was actually expected. These numbers are going to become more realistic and more one for one. I say it all the time. Once we pass the May mark, right? So starting June, July, because all this data is a month behind, we're really going to see the numbers one for one because everything really hit the fan last May, June at that Fed meeting. That's when rates really started to kind of come up as they stopped buying mortgage-backed securities and stuff like that. So we're going to start seeing things one for one as we get closer to or around June, July. Construction of new homes slowed in March, with housing starts falling nearly 1% from February. Building permits, which are indicative of future supply, they fell 8.8% for that month. We went from 1.191 million single-family housing starts in March of 2022 to 861,000 a year later, and that's with the housing market index increasing. The housing starts for single families are slowing, even though inventory actually, hold on, let me do something really quick. I don't want to share my screen here so I can show you guys this way. So, talking about housing starts. Okay. If you're unmuted, please mute yourself. I don't know who it is. Thank you. The housing starts for single families are slowing, even though inventory continues to be an issue, right? Nationally, this is most likely because builders are actually leaning towards more multifamily housing. We've seen the articles online, and it's very, very true, guys. I mean, just with building or with home builders specifically, there were 543,000 housing starts for multifamily in March, which is 2/3 of the single family starts, which is pretty shocking. We're kind of seeing, we're kind of seeing this country lean more into a renter's market. For us to only have 861,000 single family housing starts, and then 543,000 multifamily starts. So those multifamilies are going to house more families. You're really seeing these builders lean towards multifamily building, and it could be also because technically, right, our housing market index for March, which came out, shows that builder confidence from the National Association of Home Builders is still below 50, right? This is basically a scale from 0 to 100. Anything above 50 means expansion. Anything below 50 means contraction. So this could also play a part as to why homes are not being built at such a faster pace, even though we need inventory. You're seeing buyer traffic on new construction here is only at 31 out of 0 to 100. You're only at 31. You're really seeing that buyer traffic is slowed in newer construction homes. However, for the counter to just be multifamily, that's kind of scary. I think as this housing market index goes back up to 50 and above, which we've seen, we took the biggest dip back in December of last year, and we've kind of been climbing ever since. Once we get to 50 and above, that will signal expansion, and then from there, hopefully, we'll see more housing, single-family housing starts. Initial jobless claims ticked higher, and they showed the third highest reading this year at 245,000 initial jobless claims. Continuing claims, they have been steady at 1.8 million. You don't really see a decrease in it, but you also don't see an increase in it. So that's something that I think, to me, the continuing claims is really what we're going to have to concede moving forward, because those initial jobless claims, even though they may tick, if continuing claims are not moving up, that means that those people are just finding jobs. And basically, for those of you who don't know, initial jobless claims are people that file for unemployment for the first time. Continuing claims are people that are continuing on unemployment. That number has been 1.8 for a couple months now, but we are seeing our 4-week average for initial jobless claims tick up. This is important, not only for recession indicators, but also for the Fed. They kind of want to see jobs break before they slow down their Fed rate hikes. So if this number is not continuing to go up, they're going to continue to hike the Fed funds rate. The market has pretty much settled on that as a firm belief. And so if they continue to hike the Fed funds rate, you're going to continue to see volatility in the market. And mortgage rates being crazy, they're not going to continue to increase with the Fed funds rate, but the volatility still tends to be there because they don't know when the Fed's going to stop. Now, historically, when the Fed stops hiking rates in the past, that first pause, not mortgage bonds, but specifically the 10-year treasury dips on average 30 to 40 basis points, which is in turn going to help mortgage-backed securities as well, get to where they need to be. We've said this since last year. We believe that we're going to hit the fives from mid to late this year. We're already kind of seeing that come into fruition, where the Fed looks like they're going to stop hiking rates in about 2 months, which is about June, unless these numbers continue to stay stale and we don't see recession indicators. But the firm belief is that the Fed's going to stop hiking rates in about May, June-ish. And if they do, we'll see rates dip down and the U.S. Treasury dip down, and we could be in the fives by the third quarter, heading into the fourth, which is kind of what I've been saying for about a year now. There was a lot of people that were saying it could be as early as Q1 of this year. I didn't think so, for a bunch of reasons, not just because of inflation, but just because of the volatility in general. I mean, we're not going to see steady numbers in terms of interest rates until we see stability in the bond market. It's just what it is. We're not going to see stability in the bond market till the Fed stops hiking their rates, right? So the other thing I want to talk to you guys about, that's pretty much the news from last week. Want to jump into this 1% down conventional product. Exciting, right? It's not. So I did see some realtors post about this on social media. I don't know if you guys seen this. I'm going to address it before this starts being a topic of conversation. Usually with down payment assistance, I'm the biggest fan. I'll push for whatever I need to push for to make things work. But this one is specifically through UWM, which is a wholesale lender or wholesale bank, and they are big with mortgage brokers. Okay, so this would not be something that any sort of direct lender would be able to offer. Not us, not PRMG, Caliber, any of those direct lender platforms. They won't carry this. This is going to be specifically through mortgage brokers, but it's probably not going to be beneficial for your clients either way. You're going to see here the biggest takeaway. It gives you the ability to offer multiple purchase options to borrowers with income at or below 50% of the area median income. So that's number one. And I'll tell you what 50% area median income is. Number two, UWM pays an additional 2% toward the down payment up to $4,000, which means that that's only going to be a purchase price of a maximum 200,000 before you can, when you can actually consider that 2% down payment from the bank. So the good thing, the one good thing that I could see about this is that it's not repayable, but realistically, are you going to have a client at $30,000 a year? Because that's what 50% area median income is in the South Florida market. $30,000 a year is what you're looking at. 30 to 36 if you're, Miami-Dade to Broward. And on top of that, $30 to $36,000, right? Now we have to consider in this market, you're only looking at condos. And if you have no debt, right? We're talking about no debt, $36,000 a year. And then if you're looking at condos, in order for you to come in with minimum down payment, you need a full review for a condo. A full review means that you need a budget. There's not many condos, very, 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 very few condos in the South Florida market under 200,000 that have a budget. So it makes your job much, much harder to save that client $4,000. In my opinion, Florida Bond is undefeated so far. Maybe when Hometown Heroes comes out with more news of what they're going to be doing with, opening up the occupation list and what those new guidelines are going to be, because there are going to be new guidelines when it comes to that money. Right now, Florida Bond is the one that's undefeated, in my opinion, up to $90,000 income limit, up to $382,000 purchase price, but you're getting $10,000 down payment assistance as long as you don't exceed 105, combined loan to value. So in my opinion, this is not a good program, but I did see some mortgage brokers and I did see some realtors, promoting 1% down conventional. This is it. This is that program. Lastly, all right, it's the big thing here. The new Biden rule, Biden law, Biden program is just the FHFC loan level price adjustments we spoke about back in January. The reason why people are bringing it up now is because they're going to go into effect in May. They've already been in effect, okay? They're going into effect with Fannie Mae. So before we actually jump into the news, realistically speaking, when you're a bank and you're promising a rate lock, right? That rate lock is for 30 days. After those 30 days, you have about 60 days to deliver that loan to Fannie. You got about 90 days, you got a 90-day bandwidth. So if you don't deliver a loan to Fannie Mae by May 1st, those loan level price adjustments will hit, and any loans that you have in your pipeline, if you didn't go by these new loan level price adjustments, you'd have to eat that cost and you're going to lose money as a lender. So what has been happening, which is why we went over it in January, is that probably I would say about March is when these loan level price adjustments really started being added into interest rates already, right? Because those loans, once you lock in March, you close in April, and then in April, you have 30 days to deliver that loan to Fannie Mae. So you're still cutting it close, but realistically, around March is where these loan level price adjustments really started to come into play. And they're just talking about it now because Fannie Mae is now going to actually come into full effect in May. But as a lender, you have that time frame, right? That you have to deliver that loan before May, either way. That's first. Number two, people are saying that low credit borrowers are going to get a better interest rate than high credit borrowers, right? That's not the case. Okay, if you look at these loan level price adjustments, these are an adjustment to the interest rate on the back end where the rate sheet with the rate sheet, right? In terms of how much that price adjustment is. So we always talk about, right, mortgage-backed securities. If we come here and we look at right now, the 5.5% coupon is not that great. So let's show the 6% coupon, okay? So that 6% coupon right now is showing at 101.80. That means that Wall Street is paying 1.8% over 100 for a 6% interest rate right now, right? Not even realtors live off of 1.8%. So what happens? You have buffers within that rate sheet.
What else I can get out of here?
Hey, somebody's unmuted. You have different buffers, which is why rates right now are not exactly at 6%. They may be at 6.5, 6.6, 6.7. There's an extra premium that gets paid for the lender or the mortgage broker or whoever to be able to get that loan in, because that 1.8% on a $200,000, $300,000, let's say $300,000 loan, you're looking at about $4,500. That's paying your rent pretty much in terms of a big lender or a big mortgage broker, right? So there is some sort of premium that comes to it, which is why you don't see a direct 6%. Plus, there's already, without loan level price adjustments, Fannie Mae fees. They charge 50 basis points just for that. Then you have servicing fees. If you're not a servicer, right, you have 25 basis points on top of that, which is 0.25 and 0.5. So that gets added in there. That's why you see rates right now at 6.5, 6.7, even up to 7% because of that specifically. So now when we look at these loan level price adjustments, these are added into the back end. Doesn't mean that the client now goes from a 6 to an 8.25. That rate sheet has different premiums based off of what Fannie Mae wants, what the lenders want, what the investors want, right? But in this case, let's say you're at 620 credit score, you're putting in 5% down, right? That adjustment's 1.75. Maybe you're getting, maybe your rate's now at a 6.875 or 7% on that rate sheet, as a 620. That's that 1.75 adjustment. If we look at 720, 740, it's only 0.75 or 0.5, right? So they're still getting charged less than that 620 bar. Where those loan level price adjustment waivers come in, which is what people are talking about, right? Where those adjustments really come in is there is none of this counts or none of this will matter. There's no additive to the interest rate if you are a low to moderate income borrower. Okay, so there's something called loan level price adjustment waivers for people who are 80% area median income or below. Means you can be technically 620 and make $50,000-$60,000 a year, and yes, you will get a better interest rate than somebody at 740 at $100,000 a year. But it's not because specifically of your credit, because then the vice versa could happen, right? Where you are 620 but you make 100,000, and you're 740 and you make 50,000. The 740, 50,000 is still going to get the better interest rate because it's based off of income. Those loan level price adjustment waivers, they're based off of income. They're not based off of credit. Okay, that's the biggest misconception. Right now, as a 620 bar, you will still get a worse credit score if all else is the same than somebody that's a higher credit bar. What they did do, though, is they did subsidize and they did hurt higher credit bars more than they did in the past in order for them to be able to waive those loan level price adjustments for low income borrowers. So basically they favored low to moderate income borrowers, right? To basically say, okay, we're not going to hit them for any sort of rate adjustments. But in order for us to do that and keep our pockets full, which we talked about this in January, right? They made trillions of dollars when the market was declining and lenders were losing money. Fannie and Freddie still made trillions of dollars in those quarters or in those years or in the last year, while everybody else was pretty much drowning, right? And that's because they protect themselves on these loan level price adjustments, even though they know that these loans are not risky, right? We're not talking about 07, 08 where these loans were very, very risky. You would do ninja loans, you stated income type of things. These are full credit, full income, full assets that you need to be able to qualify somebody on. And the amount of people that are forfeiting their loans or getting foreclosed on is so low right now. I think it's at like 0.5%, 0.4%, very, very low number. Fannie Mae servicing these loans, they're doing just fine, okay? That was the biggest gripe I had in January is the fact that you want to do loan level price adjustment waivers for low to moderate income borrowers, cool, that's great, do that. But don't affect or don't increase it for higher credit borrowers because then what's the point of having a higher credit, right? Then we talked about possibly it's possible that now we could just do FHA, especially with the mortgage insurance being lower on FHA loans now, because that's another thing that people are not talking about. Mortgage insurance is increasing on the back end for these Fannie Mae, Freddie Mac loans. Nobody talks about it because it's not pretty, I guess, or only loan officers see it. But mortgage insurance is increasing heavily on the back end for Fannie and Freddie loans, even with higher credit borrowers. And so it typically makes more sense right now to be able to go FHA. But to say that low credit borrower is going to get a better benefit than a higher credit borrower is only half the truth. I wouldn't say it's a full lie, because if that person, like I mentioned, is low to moderate income, then yes. But realistically speaking, it's based off of income. It's not based off of credit. You guys can see here, these adjustments are much, much higher, right? The lower that you go in in credit. Now, what I can tell you is look at these huge adjustments based off of higher down payment, which is very, very true. It doesn't matter what credit score you are. So you go from, if you were doing less than 5% down, you get a 1.75. But if you're doing 9.9% to 5% down, you get 2.25. You get a higher adjustment the more down payment you go right now, no matter what that credit score is. And you'll see it across the board. Even as you go up, those numbers increase, which is pretty crazy, right? They're really kind of forming towards first-time home buyers, which is why it's that above 95%. Only people that are first-time home buyers can do 90% down, 97% down. Anybody else, it's a second-time borrower, you have to start at 5%. So those adjustments are being made across the board, but they're much less the higher that you go in credit. But they're still being done. Before, there was really no adjustment. 740, when you got to 740, there was no adjustment, no matter what that down payment was. There was no loan level price adjustment waiver. And you'll actually see, let's see this one. This is actually a good heat map. It shows which ones are higher loan level price adjustments from before and which ones are lower level price adjustments. So they did take care of low credit borrowers here, where they gave them less loan level price adjustment than they did before. And then they did hurt these middle people here, going anywhere between 10 to 19.99% down for the most part. But they did it all the way as low as 680, right? Is where they really affected most people, from 680 to 760. These higher LLPAs. So these negatives mean that before there was nothing there. So you would actually get you wouldn't have a loan level price adjustment before, negative 0.5, negative 0.3. And then there was loan level price adjustments down here, but they made it more beneficial for lower credit borrowers. But guess what? They also made it more beneficial for higher credit borrowers doing down payment as well. Okay. So it's not like, yeah, they took care of all of this is green. Yes. Well, this is green as well. And these are higher credit borrowers. They're focusing on low to moderate income, and they're focusing on first time home buyers doing down payment, doing low down payments. That's what they're focusing on. Okay.
Hey, we're going home. She better take her home. Go home and go to bed.
Okay. Do you guys have any questions or anything like that? Any scenarios that came up this week? They can't exceed that income. Lorraine, Lorraine, what were you saying? Bond would push the buyer rate, though, right? Yeah, so the bond has its own interest rate, but the bond's interest rates are lower than what actual market rates are, for the most part.
And the other question that I asked, when you were talking about the 1%, that 1%, that 1% conventional loan, that income limit cannot go over the 36,000?
Yeah. So they have to be 50% area median income or below.
Okay.
Yeah, it's very, 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 very few people. And those people, like I mentioned, even with no debts, you're looking at condos with no budgets. Automatically, Fannie Mae and Freddie Mac say you have to come in with 10% down. So that's the minimum combined loan to value. Really, it's 25, but then you can get a second loan to help you. But your minimum would be 10% down if we were doing a condo with no reserves. But yeah, and you asked me to speak about the Biden thing. That was pretty much it. Those loan level price adjustments. It's not necessarily a Biden law, not for anything, but it's directly through Florida Housing. Not Florida Housing, through the FHF. No, not FHF. Why did I say FHFC? FHFA, Federal Housing Finance Administration. Okay, it's directly through Fannie and Freddie. They're the ones that came up with these loan level price adjustments, and they're more for first-time home buyers, low down payment borrowers, and low income borrowers. It's not specific to the credit, and lower credit borrowers are still going to get a higher interest rate. You guys have any questions for me? Any scenarios? No, I can tell you before you guys leave, I didn't see any of you posting about it. Maybe I wasn't on social media, but I thank you guys if you didn't post about it. If you guys have any questions, let's come and let's talk about it here when it comes to the mortgage stuff that comes out during the week. I try to put out videos if I can quickly. Sometimes I can't. we have this set time, this set schedule, so that way we can talk about it and really kind of go in depth about what these programs, what this news really is, and kind of what it boils down to. And that way you guys get the facts all the time.
A question that I
Mike,
do
I
have,
had a-
Mike. Go ahead.
No. Go ahead.
Wait, it was Nikki and Lorraine?
Lorraine, go.
Go ahead, Nikki.
So, Mike, I was asking you, I know, and I did a video, I'm going to post it today, about the Miami-Dade employees.
Yes.
As far as the down payment assistance that they're getting through actual county. Now, let's say I have a client, they are an employee, get the assistance. Is it similar to like, do they get the assistance and then that goes towards the loan, or when they do the application, does it process through your office?
No, they do it
How
directly.
does it work on the
through-
back end?
Yeah, they do it directly through the HR for the county. So
Mhm.
basically, it's down payment assistance, but it's their money. It's their accrued pay time off. So it's not going to affect it's not like they owe that money back to the county. It won't be a loan, won't be anything, at least from what I've read. It's specifically your accrued time off. You got 300-400 hours. They're going to allow you to get that and formulate that into actual cash that you'll be able to use towards your down payment. And it'll come out as basically almost like a bonus, so that it doesn't really affect, getting a deposit or a high deposit or whatever. So they'll be able to utilize that, and they can also utilize, if they're a hometown hero, they can still utilize hometown heroes. They can still utilize any sort of other programs, because it's just them putting together their money through the pay time off that they have, and Miami-Dade packaging it for them and just giving them those funds.
Awesome. Okay.
Lorraine,
So
you
the
had
question-
something else?
Yeah, so the question I wanted to ask is in regards to these condos and the 20 or 25% down that they're requiring. What caught my attention over the weekend is that on the listing agent side, I noticed that some of the agents are saying if your lender requires the 20 or 25%. So we don't have the reserves, but if your lender requires it. So is it that some lenders are not requiring it if they don't have the reserves and others are? Is that a direct versus a broker? Like what is that conversation all about?
Yeah, so no, I mean, standard guidelines say that if there's no reserves, we have to do a limited review, which is on the front, your loan to value is 25% down, but you can get a second mortgage or a second loan that'll cover you up to 89.9% loan to value. And so you only come in with 10% down. Now, there are different interpretations of budgets and how to read them that some lenders may be okay with and some may not, which is why I always say, send me the budgets, because if there's no reserves, there's no reserves. But if those reserves are like, let's say 7 or 8%, right? They're right there on the edge. There's things that you can minus out of the budget. And I'll probably, actually, it'll be a good idea to do a condo training with you guys. But there's things that you can minus out from the budget to lower the maximum income that they receive. So let's say if they are getting $1 million a year of association dues, and they collect $800,000 in reserves, right? They still don't have 10%. $80,000 of reserves. They still don't have 10%, right? They need to be at 100. And so from that, you can minus out, let's say they do cable and TV, right? That's not a necessity when running an association. That can be minused out of the budget. Let's say that's, just to make the numbers easy, $200,000 exactly. So now they collect 1 million, but 200,000 is from cable TV. Technically, their budget's at 800,000. Their reserves are at 80,000. They can still do a full review through Fannie Mae. And this is something that a lot of mortgage brokers typically don't do, because they're sending to wholesale lenders. This is something that banks typically don't do, but it is a Fannie Mae guideline that you can deduct things from the budget that are not specific to, I forget the exact wording, but basically that it's not important to be able to run the association, like cable and TV and stuff like that. So there's ways that you could do that. And then that's why sometimes some lenders will say, yeah, we could do it as a full review. And some will say that they can't because some are willing to minus out from the budget and some aren't. But as long as it's the Fannie Mae guidelines or it meets Fannie Mae guidelines, we're able to do it as a full review But typically, if there's no reserves, there's nothing we can deduct, then you're going to have to come in with 25% down or 10% if we're doing the second loan. Some lenders may read that incorrectly and they may do the loan, and that's great. But what happens is if that loan gets audited and they did an incorrect job, they will have to buy that back at 75 to 80 cents on the dollar. And that's how lenders and banks and other companies go bankrupt. So have to be really careful. It's a really fine line sometimes.
Okay, and I think definitely doing a training with us in regards to how we can read that budget would also be very beneficial.
Yeah. I'm gonna write that down. We're gonna do that so that way we can do a nice little condo thing training, and I'll pull up like 4 or 5 different budgets and we'll review them together. You guys got any other questions?
Yes, I do. In regards to the Miami-Dade employee program, I got posed the question, how do they figure out how much money they're going to give you? And I know it was based on the amount of hours. So an employee asks, does it depend on your salary, how much that particular leave hour cost? Or
So that's
is
not in
worth-
the actual memorandum that I have, but I believe that that's the case, right? It's depending on your actual accrued paid time off and how much they pay you for your PTO. If it is based off of your base, then it's going to be, that's because it is your money. You're not borrowing money from them. So yeah, it would have to be based off of, my assumption would be based off of that.
Okay, got it.
And so the only thing is that they do have to keep 80 hours in their leave bank. Okay. So if they have 100 hours, they can only use 20, 200, 120. They have to leave 80 hours in their leave bank. That's the only other requirement. So they have to be there. They have to be
Okay.
employed for at least 3 years.
Okay, got it. Thank you.
No problem.
Mike,
Yeah.
how you doing? This is Anne Marie. Listen, anybody, who wants to go through the Miami-Dade program, they have to call HR to find out how much their leave is. I'm a county employee, so they call and they tell them how many hours they want to use, and they'll tell them from that point how much they have available. Because just like you say, everybody has a different pay rate. So you might be at $10 an hour, somebody might be at $50 an hour. It all depends on your hourly rate.
Yeah, which was my assumption too. There was nothing in the memorandum that said something differently. But yeah, thank you for clearing that up, Anne.
Thank you.
No problem.
You guys got any other questions for me? Good. Okay. All right. Well, we'll see you guys next Monday. It's not a holiday right now. I'll see you guys next Monday. Anything that you guys need throughout the week, just reach out to us. Thank you all so much for coming and have a great week.
Thank you.
Thank you, Mike.
Thank you.
Thank you, you too.
You, Mike. Have a good day.
Thank you.
Too.
Thank you.